Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. Hope you're doing well today. And if you're new here, every Friday and sometimes Saturday like today, I break down the latest news and the hottest topics in the world of technology and cryptocurrency whilst drinking a cup of delicious coffee. Now in today's episode, we've got a special one today about the Bitcoin bull run speculation and Ethereum 2.0. And of course, we're going to do our usual 404 Logic Not Found segment as well. And before we get into all that stuff, we're going to kick it off with questions from the community on YouTube and Twitter. And I'm going to pull those up now here. And if you want one of your questions answered, please do leave them down in the comments below or tweet me at Hashoshi4. I try to answer 4 or 5 a week. And if you would be so inclined, please do subscribe to the channel and hit the little bell notification button so you get a heads up whenever I post new stuff here on the channel. Thanks, and let's dive into these. Now, the first question is from Cynthia Cruz. Sorry for the stupid question. No stupid questions here. What is KYC? Now, I talk about KYC on the channel a fair bit. It's a controversial topic, but KYC stands for Know Your Customer. And it's part of regulations that many governments around the world require for any institutions that deal with money, especially ones that allow you to send money to other people, especially across borders. And essentially, it is the process by which you prove your identity and your citizenship to participate in a given service. So when you sign up for crypto exchanges where you might be sending crypto to other people, or you can convert cryptocurrency to dollars, they require you to do KYC on the platform. Sometimes that's just filling out your information with a social security number or another identifier. Sometimes that's giving them a copy of your identifying information, so your actual ID. And this is part of a processes by which they, protect sanctions, they deal with anti-money laundering, they deal with all sorts of things. That's what the process is. I think that KYC is antiquated. I think there are much better ways to prevent bad things from happening than storing a ton of personal identifiable information or personally identifiable information, PII. And I think that we should be tracking towards those things rather than just settling for this kind of crappy way of doing KYC. So it's the balance of stopping criminals from doing what they're not supposed to do and storing a bunch of information and invading people's privacy. So it's a duality, and that's why it's so controversial. But that's what KYC is. Thanks for your question, Cynthia. Now, the second question of the day is from Eugen I. Any thoughts about self-key? I will be moving with my fiance from Germany to the USA. Congratulations. What consequences do I have holding, investing BTC and alts in exchanges? So the first part of your question is about self-key. Self-key is a digital identity provider, and it actually kind of ties into the first question because theoretically, platforms like self-key could provide a more decentralized networked way to provide identity attestations, prove who you are, without having to give up a bunch of information. So in this case, self-key is basically a blockchain-based solution to help build a digital identity upon basically a private key. And that would allow you to make attestations, sign transactions related to information about you without actually having someone else store that information. So it's a self-sovereign identity platform. I really do like the project. I think it's quiet and there's not a lot of marketing, but I think they do have a really cool idea and I hope they succeed. And in terms of your, holding or investing BTC and alts in exchanges when you're moving, I would just ensure that when you do move from Germany to the United States, that the exchanges that you're on will still allow you to use them. You'll have to reach out to them to talk about regionality. You might have to shift your account. You might have to open a new account and then go through KYC here once you establish in the United States. I'm not exactly sure. It really is dependent on the exchange. But in terms of taxes and other things, that's something you'd have to ask a professional about. Everyone's situation is very, very different. But I would just make sure that you are not going to move and then find out that you can't access those exchanges anymore because they're geo-locked to only Europe, or they don't allow US people, which happens all the time. So I would definitely research, talk to the exchange or exchanges plural. And my recommendation would be, as always, move your crypto to a cold storage wallet. Then you don't have to worry about this because it's never locked to an exchange. So I've said my piece. Thanks very much for your question. Third question today is from Louis Bradshaw. Any idea how much ETH we get per month or anything if we lock up our Ether? Can't really seem to find that info anywhere. Thanks. Yeah, so when Ethereum 2.0 comes out for staking and validation, if you are a validator on the network, right, you should be able to earn rewards. You earn ROI for contributing to the security of the network, helping to mine blocks, I guess more so mint blocks now, or make blocks. Ultimately, there's no solid answer of how much reward you're going to get, right? But the thought is mathematically it's going to be anywhere from 5 to a little under 10%. So my estimate is it's probably going to be 6.5, 7, or 8% return on investment annually. So I would say that is probably what you will likely see on Ethereum 2.0. I think that it's going to fluctuate because it's an economic math problem basically. So when the network launches, the rewards might be a little bit higher because there's lower concentration. It might be a little bit lower because more people are participating and then they ditch. It's really hard to say for sure, but I would expect between 5 and 10% return on investment. So by no means is this going to be something you live off of, I guess, unless you have a ton of Ether. But yeah, something to watch, and thanks for your question. Last question of the day is from Durrani Motion. Hopefully I pronounced your name correctly. My apologies. Brilliant show. Thank you very much. Will Polkadot benefit from this ETH 2.0 delay? So Polkadot, it's kind of funny because I think a lot of people think of Polkadot unilaterally as an Ethereum competitor, and I don't actually see it that way. I actually think that Polkadot is more so something that could save Ethereum long term, because Ethereum could very well benefit from the interoperability protocol that Polkadot is creating. I do understand, though, that there will be smart contracts on parachains that are in the Polkadot ecosystem, and it could very well hurt Ethereum. And there are rumors that there is a Polkadot parachain that is making a copy of Ethereum to work in Polkadot's ecosystem, much like Ethermint and Cosmos. And I did a video about that a while back, and I said that could be what really hurts Ethereum. So I guess from an economic perspective, yes, Polkadot, Cosmos, Tezos, Algorand, Cardano, basically every smart contract enabled chain, Elrond is another one, they're all going to benefit from this delay because it's going to give them an opportunity, one that they haven't really had at all to date, to actually take some market share from Ethereum in terms of developers, in terms of users. They can spend some time building tooling, which is important, building out the user experience. So yes, everyone's going to benefit from Ethereum 2.0 being delayed. But Ethereum 2.0, really, the timeline hasn't changed a whole lot. It was always going to take until 2022, 2023 to be really ready. So nothing has changed, and I think all these projects have been planning for that all along the way. And any delays in the beacon chain are really negligible because the beacon chain coming out really doesn't do a whole lot. It's just the base layer and phase 0 that's coming in. It's not going to come in December. We're going to talk about that shortly. But when it comes, it's not going to do a whole lot. So the answer is yes, but how much is going to be dependent on each of those projects and what they do with that time. So that's going to do it for the questions today, folks. Well, let's dive into a giveaway and the news. Now, for those of you who are new here, every week in partnership with the folks at Cobo, who make the awesome Cobo Vault wallet, I'm going to be giving away a Cobo tablet steel seed phrase backup device in every episode. If you've been here every week, thank you. You're going to get chances to win every week. And all you have to do is enter by commenting down below. And I will pick a random draw every single week, and I will message the winner, and then you get your prize. Simple as that. But just for transparency, though, the product is only available in the US, Canada, and Europe. So if you win and you're from another region, I'm just going to send you some Bitcoin instead. Now, the winner of last week's giveaway is here on the screen. You'll see the random draw, and a big congratulations to you. Of course, I will be in touch, and I will also be picking a second winner to get $50 US in Bitcoin today. So please do comment down below. Now, to kick off the news section, you can probably guess that we're going to go straight to Bitcoin price analysis for the week, as we always do. And it was a bit of a roller coaster week with some pretty steep drops that I think tested the 14K range. And we ended, though, on a high note here with Bitcoin breaking above 16K, 16,000 US for the first time since the last big bull run. And I have to say, it is starting to brew on crypto Twitter right now. People are really doubling down on the bull run rhetoric. I'm not totally sold on a bull run, but the data is looking promising overall. It does look a lot like 2017 did back then. I remember that excitement that was brewing. And in terms of the growth trends, the miner activity, ownership patterns on exchanges versus self-custody, transaction volume, etc., stuff looks similar. And one thing I did notice several times this week is that fees on Bitcoin were dramatically lower than before. The mempools, like the transaction queues, were empty. And it seems everyone that is holding on tightly, waiting for that next big price jump before they sell. So to be honest, it could be this human activity causing price to move upwards because there's so little sell pressure right now, but really, who knows? And I do want to just throw this out there. If you're watching this channel and you weren't here in 2017, congratulations. You're still getting in on the ground floor. It's still early. But please listen to the people who were here in 2017 and learn the lessons that many learned the hard way. Take profits. And I'm no financial advisor. I don't claim to be. And so I want you to take this with a grain of salt. But I'm of the mindset that you should play with house money as much as you can. If you put, say, $1,000 into Bitcoin and you double your money, take your initial investment out of the game and then gamble long term with what's left. If you want, maybe take it all out, but that's up to you. You're playing with profits at the end of the day, but your initial investment is safe. So good risk management and knowing when to take profits is critical in this space. And if we do get another bull run over 20K, please don't be the person that keeps waiting for the next big number. Take your profits along the way so you can actually lock in some of these wins. Yeah, don't be that person that holds to a new all-time high and then rides it all the way back down again due to the sell pressure that comes after. We've all been there, no matter how experienced we are in the crypto space. Everyone does this, everyone. And you will see people on YouTube, Reddit, Twitter, even just your buddy next door waving the stock to flow model in your face, screaming, hodl on, because 100K Bitcoin is right around the corner. And I'm telling you, and I'm willing to bet that the stock to flow model is a load of garbage. And it's a great thing to look at. It's a great thing to use our imagination with, but it's not the holy grail of prediction models. And please do not make decisions based on that. The only thing predictable about the Bitcoin market and really crypto in general is that it's unpredictable. So the way to protect yourself is by taking profits, managing risk, setting price thresholds early on to tell yourself when you're going to take money off the table, and try and stay less emotional. Really hard. I even have really hard time with doing that. But again, not financial advice, just a friend who cares about you sharing some thoughts. Now it is time for 404 Logic Not Found, and for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this video get some attention from the YouTube algorithm, please do hit that subscribe button, and please do like this video because it tells the YouTube robots that you're enjoying the content that you're watching and that other people might want to see it too. So thank you so much for that in advance. And I'm feeling a little bit crazy these days because I've dared to enter the ring and call out Ripple already one time this month, and I'm about to do it again. Now, the Ripple CEO, Brad Garlinghouse, took to Twitter recently in the wake of Joe Biden's projected election as president. Yes, everyone's going to go in the comments and get angry because I said something political, but whatever. Anyways, Garlinghouse kind of subtly called out Bitcoin and companies who utilize Bitcoin. And this tweet came as a response to another tweet about Biden's policy proposals for mitigating climate change, which Garlinghouse kind of used to aim at companies like Square, who hold and evangelize Bitcoin. And he used them to imply that these companies like Square should be concerned about their contribution to climate change as a result of Bitcoin's proof of work consensus mechanism and its high usage of electricity. Now, conceptually, Garlinghouse has in the past postured the idea that Ripple and their products are superior to Bitcoin because they use less energy. And there's an article online about their sort of superiority as a result of their environmentally friendly protocol. And now it seems like this is just doubling down on that idea with his tweet about the concern Bitcoin companies should have about their climate impact. Now, here's my challenge with this. One could argue that the claim that Bitcoin's energy usage in the first place is really a bit misleading. According to a 2019 study by CoinShares, it was estimated that around 74% of Bitcoin's usage of electricity driven by mining was actually provided by renewable sources, or at least semi-renewable sources, which sort of erodes the argument that Garlinghouse and others are making here. Am I saying to you that Bitcoin is an efficient network? No, it's not built to be. This is a feature, a critical feature, not a bug. The inefficiency of the protocol is what inherently offers the true finality and security of the network without a centralized entity to validate transactions. My point here is that energy efficiency and carbon neutrality are two very different measures. Bitcoin mining is far from the global climate calamity that the media would like to characterize it as. And if the progressive move towards renewable energy continues, it will continue to get better and better in terms of its environmental friendliness, Bitcoin that is. Personally, I think this argument Garlinghouse is making to disparage Bitcoin and, more concerningly, Bitcoin-friendly companies like Square is just pretty weak sauce overall. Ripple and Bitcoin are not even in the same universe in terms of how they're built, the features they offer, how they work, why they work. And quite frankly, carbon neutrality is rather low on the list of features users are looking for in terms of adoption. So I think the focus should be making products that work and get adopted first before we start trying to rip each other down. And so if no one uses XRP, right, if no one uses Ripple's products, the world will not reap the rewards of the supreme energy efficiency that that protocol claims to offer. Now, another interesting note here is that if Garlinghouse's logic is applied to other companies, like crypto exchanges, for example, don't you think that they will get destroyed by regulators as well because they have quite a lot of Bitcoin and they move quite a lot of Bitcoin? They not only use Bitcoin too, but every other proof of work network out there. So if exchanges get crushed, I don't think that's good for XRP and Ripple either. Anyways, I'll never understand why CEOs and leaders spend so much time taking shots in public commentary when they should be focused on their own company. And when their own company is underperforming against the high expectations of their generous and loyal investors, it just makes no sense to me. 404, logic not found. Now, it's time to talk about Ethereum 2.0. This is another Ethereum 2.0 heavy episode, and I did a large segment about this last week and the truth about the ever-hyped launch that's targeted for December 1st, 2020 for the Phase 0 beacon chain of Ethereum 2.0. Now, this week is part 2 of that sequence. Now, this release date is contingent upon the 524 some odd thousand Ether being committed to a deposit contract, which is right now live on the Ethereum 1.0 or proof of work network. Now, this is the process by which Ether deposits come from the proof of work network that we have today to be ported over to the new Ethereum 2.0 chain. Now, it seems that only truly dedicated Ethereum folks are committing their Ether right now, which is a bit of a concerning trend. Now, we're less than a month away from the proposed launch, and there's only a little over 10% of the required Ether sitting in deposit as of measurements taken towards the end of the week this past week. Now, what's more challenging is that to hit the December 1st release date, the threshold has to get hit by, I think, a little over 2 weeks from now, maybe even less than 2 weeks now. So that's not a whole lot of time, and I don't think it's going to happen. The majority of those so stoked to join the network have already committed their Ether, and you have folks like Vitalik Buterin contributing thousands of Ether, which might make it look like the numbers are better than they actually are because you have really high rollers dropping Ether into the mix. I don't personally see any way that December 1st sees the beacon chain launch. This is going to take some serious marketing to get done, and people need to contribute Ether to that deposit contract like yesterday. Now, let's break down why this is happening, though. Now, first of all, I think that very few people besides Ethereum fans even really know that this is happening. No one even really knows the deposit contract is live, and if they do, they don't know where it is or how to do it. There's no instruction guide online that's super easy to find and clear to follow. There are out there, but they're not very clear. And there is no marketing happening, at least not that I've seen. That's a problem. Now, secondly, those who do know are likely not interested in locking up their Ether in a contract that's likely not going to reap them any rewards until next year. Now, it's very unlikely, in my opinion, that this launch in December 1st is going to happen at this rate. So when do I think it's going to go live? And the ultimate truth is no one has any clue. So they don't want to risk having their Ether locked in that contract for God knows how long. Especially with prices going up, Ether has done pretty well in the market, and people want to be able to sell their Ether. They don't want it locked, and I totally get that. So how can we solve this problem? Is this a death signal for Ethereum? Well, first things first, no, it's not a death signal, but it is definitely frustrating. This launch will happen, but the question is when, and no one can answer that with certainty. So the issue of filling the deposit contract could be helped in a handful of ways, but one of them is significant effort in marketing how to do it, why to do it, incentivize people to do it. And the second way would be to enable creative ways for people to feel less uneasy about locking their Ether for an uncertain amount of time using maybe liquidity protocols or alternatives like it. In essence, I would be more willing to drop my 32 ETH into the mix if I can use it to trade, or even hell, sell out of Ether if prices hit a certain point and I hit my threshold. If it's just stuck there and I'm helpless, I don't like that. I want to have control over my crypto. Now, one such project that might help this is called Liquid Stake, which is under the roof of Dharma Capital, a licensed and regulated entity that makes this service actually viable at the end of the day. But what Liquid Stake provides is that it operates in a fairly simple way. Instead of depositing Ether directly into the deposit contract, you deposit with Liquid Stake instead. They in turn give you a loan of USDC or US dollar coin equivalents to that value that you sent them in Ether, which you can use to buy Ether elsewhere if you want to lock in a long-term investment, or you can use it for whatever you want. Then you can later utilize Ethereum 2.0 staking and validation capabilities through Liquid Stake as normal. So basically, this is a custodial and centralized system whereby someone who wants to contribute to Ether 2.0 can still have access to their Ether or their assets while they wait for launch. It's believed that this will alleviate some of the disincentive issues for people that want to contribute to Ethereum 2.0 but aren't going to because they basically lose access to their crypto. And this means that you can stake and participate, but you can also hold your cash if you need it. You can hold on to your crypto if you need it, which is a great idea. Now, I hope more services like this crop up because competition is good, and I hope that this puts pressure on them to make their product better. Now, another way to solve this problem, though, is to allow people to contribute less than the 32 ETH validator limit, which is likely what's stopping a lot of people from participating in Ethereum 2.0's deposit process. There are rumblings of some protocols that will allow you to do a sort of group effort, right? So you and a group of friends could pool 32 ETH with like a multi-sig type construct and deposit it through that unified wallet together. And that would be pretty helpful because that would reduce the $14,000 burden that 32 ETH imposes right now. So all in all, I really hope that there are more creative ways to get deposits rolling in because I just don't see the incentive there right now. And I don't see any indication, any whatsoever, that December 1st is a realistic launch date based on what we're seeing right now. I would love to be wrong. It's not the end of the world, but I don't think it's happening in December. Now, in other news, many of you may remember the absolutely insane events of September 2020 where everyone was minding their own business and then all of a sudden, the KuCoin exchange started looking a little wonky. And very sleuthy users noticed that assets leaving KuCoin wallets to unknown wallets started to begin looking like a full-blown hacking event. And it turned out those fears were founded. And all told, $280 million in assets were stolen as part of this hack. However, now here we sit in November and KuCoin has renewed operations for nearly 180 of the total 230 assets they have available on their exchange after having to shut down basically everything during the hack. Now, it's believed that there were new safeguards put into place to prevent further issues. There were some patches to some of the holes in their protocols, and any assets that were being targeted for recovery were hopefully recovered for the most part. Now, with cooperation of many of the listed projects and other centralized projects, if you will, they did rollbacks and other things. Reports are now coming out and say that about 85% of the total losses of assets were recovered for users. Now, this leaves 15% still unaccounted for in terms of total loss. Now, there is controversy about this type of thing because rolling back balances for ERC20s and other tokens it is a centralized move by projects. But of course, if they don't do these rollbacks and they don't get everyone's asset back, then everyone complains about losing their value. So moral of the story, folks, get your crypto off of exchanges and you don't have to worry about any of this. It only takes one time getting burned before you learn that hard lesson. And look, I'm not perfect either. I get in the spot where I'm like, okay, I'm gonna sell this soon, so I'm not gonna move it. I'm just gonna leave it there. And then I forget, and then my crypto's sitting on an exchange, which is not good. So please use cold storage. But good news overall for KuCoin users, your assets are probably back where they were supposed to be. Now, I know this was an Ethereum 2.0 and Bitcoin heavy episode, but next week will mark a return to the widely varied news cycle. But I feel it my responsibility to communicate the truth about the Ethereum 2.0 saga and what you can really expect, because as much as I love Ethereum, people need to have an understanding of what's going on. And there's very little information out there. So as always, folks, thank you so much for watching. And if you have time to stick around, you can check out last week's Crypto Over Coffee. I'll link it here because it has some more details on Ethereum 2.0's launch. I wish you and your family a safe and happy weekend. And until next time, cheers.